So good morning, sir. I'm here to do my presentation on the topic capital reserves. So a capital reserve refers to a specific fund or amount set aside to cater for future or unpredictable expenses or losses of a company. It is an account on the company's balance sheet put aside to settle financial emergencies or capital losses that a company might face in the future. Capital reserve is set aside for unpredictable expenses or long-term invested projects of a company. It is not useful when a company needs to pay dividends. They are permanently separated from other accounts, usually through investments. An accumulated capital surplus, such as profit and appreciation of current market value of a company's assets, make up the capital reserve of a company. Now, further moving to my topic, a company may create a capital reserve through a variety of transactions, including selling fixed assets or the upward revaluation of assets to reflect their current market value, issuing stock in excess of per value or profits on the redemption of debentures, and reissue or forfeiture of shares. So, in other words, we can say that the capital reserve is created through capital profit, not through the company's everyday business. The purpose of capital reserve or cash reserve is to allow a company to meet unexpected short-term costs without taking on excess debt. It does not include anticipated or long-term cost. The capital reserve is generally held in a company bank account or may be invested in high liquidity securities. Now, further moving on, the uses of capital reserves. Capital reserves are amounts of funds put aside for settlement of contingencies. They are accounts of a company's balance sheet that are marked for specific purposes, such as long-term projects of offset and capital losses. Capital reserve is often regarded as misdated or dislocated concept. This is because because reserve as a term is not captured in the generally accepted accounting principles GAAP, and capital reserve do not play any role when measuring the overall wellness of any business. They do not indicate the trading or operational technical employed by an organization. Now, the requirement of the capital shares, a solid cash reserve, according to financial advisors, might be equal to 3 to 6 months of company's ordinary expense. Sums allocated to a capital reserve are invested long term and cannot be used to pay dividends to shareholders. They are marketed for specific purposes, which may include long-term projects, mitigating capital losses, or other contingencies. A capital reserve is created out of non-operating activities and is unrelated to the company's stock performance of the company's operational activities. Therefore, it cannot be used as an indicator of the operational health or the betterment of a company or a business as a whole. And now, how do these businesses invest in reserves? So the simplest way of business to invest in such this is in unneeded cash reserve is to store the excess in savings account, where it will earn a small amount of interest. Companies with more substantial reserves may invest their money in money market instruments such as cash equivalent securities for extra interest. And how these capital reserves should be shown in a balance sheet. So in case of balance sheets on a financial statement, capital reserves or other surplus capitals should be listed in the section of shareholder equity. This reflects the fact that these assets can be used for future expenses or unexpected losses. And the raising of capital, the simplest way of a company can raise capital is by selling equity, either through a private settlement to select investors or by selling shares in public offerings. They can also raise capital by borrowing money or selling bonds. In a pinch, a larger company can also raise funds by selling their assets, such as unused property or even corporate subsidiaries. So that's pretty much all about my topic about capital reserves and how they are formed and what are the uses. Thank you, sir.